So here's a pretty interesting case study I got from an advisor today. So client is around 66 years old. Their house is worth around 600,000 and they still have a mortgage balance of roughly about 142,000. So what I tell everybody is what makes a reverse mortgage a good idea or a bad idea is what do you do with the money you're no longer putting in the house? So to kind of make numbers easy for the example's sake here, I'm saying she still has a payment of roughly about $1,000 a month. And we have at least 15 years, maybe more, on the mortgage still left to be paid, but at least 15 years at a minimum of $1,000 a month. So it's 180 months at $1,000 a month going in to making mortgage payments. Well, where else is that $180,000 that would be paid over that 15 years better spent? So what you see right now is just a basic simulation, assuming a couple different things. One, of course, assumes the house value and the mortgage balance at 142. But the biggest thing to take a look at is the interest rate. Now, when we do simulations like this, the interest rate is what we call the expected rate, which is based upon the 10-year treasury. That number fluctuates typically on a weekly basis. It can go up, it can go down. Of course, right now with the 10-year treasury being as high as it is, this number is higher than what it's been in some time, as far as that goes. But we also know it's going to go down here, hopefully in the near future. 2025 is what a lot of experts think we'll start to see interest rates really start to come down quickly. But for the example's sake here, we're going to look at it two different ways. We're going to look at it at this rate of 6.76 throughout the entirety of the loan. And then we'll look at it here in about a year or two, dropping down to being average around 5.5, which I think is probably a little more realistic bet. I mean, nobody really knows. It's only a guess. But if we look historically, the rates with reverses have been fairly low. So it just kind of depends on how you want to look at it, how positive or pessimistic you want to be on rates. So as we can see here, if we wanted to go 15 years, if we say this client, if she continued making mortgage payments for the next 15 years, we see that the balance of the mortgage at the end of that 15 years would be about 481,000 or $482,000. And by the time she would sell her house, assuming a 4% appreciation on the growth of the house, then you're looking at walking away with about $600,000. So, not too shabby on that end, especially when you come over here to just a basic time value of money calculator or investment return calculator that I'm using on Smart Asset. If we took that same $1,000 a month and threw it into just whatever investment account, you pick it as far as whatever an advisor would recommend, and let's just say you get 7% return on your money, well, you're looking at about $320,000 over that 15-year period in cash. So a very important distinction with the reverse product is at the end of the loan, you may have less equity than you would have if you would have continued making mortgage payments, but you should have more cash. And that is shown here as far as how the money is best spent or best utilized over that 15-year period. The other thing to kind of play with here is let's just say we got 8% on our money, then you're looking at 350,000. And then some people love to say that you can get 10 or 12%. So even if you got 10% at that point, you'd be over 400,000. So I still like the 7% just to be conservative on it, about 320,000. So when you look at 320,000 plus the 600,000 here, you're sitting right about 920,000, give or take a little bit. And that's assuming that the interest rate averages the 6.76. Well, we already know that rates are likely come down. So let's just say in 2026, we start to see a rate of 5.5 or something lower than that even. And we just average 5.5 the entire time. So once again, going out 15 years, 2039, then you're looking at a equity standpoint about 670,000. Your loan balance is about 400 or 410,000. So when you take a look at that 320 plus the 670, you're not really that far off than if you would have just paid the mortgage the entire time. And of course, this takes in a variety of factors that we cannot control. Unfortunately, you cannot control how much your house is worth at the time or when you sell it. So you never know if you're going to sell your house in a 2008 or you're going to sell your house in a 2020 or 2021, right? It's very hard to time when that house is sold, especially if you have to move based upon health needs or frankly, if you just pass away. So once again, it's about where's the money better utilized. Cash is more valuable than equity. Equity looks really pretty on paper, but it's absolutely useless until you sell said house or said asset. So I always like to say, where would that $1,000 a month be better spent? Is it an investment account? Is it a life insurance plan? Is it into some sort of annuity? You pick, or you talk with an advisor of where that money is better placed. But I'm willing to bet you anything, it's better placed in somewhere you can access it when life events happen to you down the road, that you have the accessibility to that, and you're not making that $1,000 a month payment and tying it up into equity every single month. So I hope you like this video. If you do, please like, share, subscribe to it. You know, our point here is to be a resource and a value add, and just hopefully educate on the topic and how the reverse mortgage product can be part of your retirement plan.